Hello to you all, welcome to the Ipsimus strategy explanation video, and in this video we are going to take a look about how this strategy works, its components, the markets which is being used, the pro and con, how to properly set up an alert, and stuff. So yeah, let's get on with it. The Ipsimus strategy, it's a similar strategy like with dominoes, but this one compared to that one is that it's mainly adapted to the stock market. In a way it's a full trending strategy. It doesn't matter if the market is going to go long or short, it's going to benefit from it. However, due to the nature of the stock market, you can expect far greater results from the long trades and far bigger profits than with the short ones. You can also, if you want, just use it as a long only, and you're going to be safe with it, even safer. So yeah. As with dominoes, our main components are going to be the index for X, index and Y. In this case, the index for X is going to be for long, and the Y is going to be for short. Just as with the other one, we are going to have an average of moving averages and of oscillator. So in this case, it's telling us that 10% of everything that we have is going to be positive, or it's going to be trending bullish. And 70%, for example, is going to be telling us that 70% of all our indicators are telling us to go short. And the other components that I adapted to it is going to be the stop loss for long entries, which is going to be dynamic as well, and for the short entries, the take profit and stop loss for take profits. And then if you want, you can have a static one as well, just like with the other one. But in this case, for example, this one doesn't matter so much for us because here is the main action and where the alert is going to be triggered. Now, if you want as well, you can use, because as I said, initially these strategies, they've been made to the index. So in this case, for example, we have the Nasdaq 100 or SP 100 index. But let's say, for example, you want to trade, I would say, Apple. And instead of using the Apple candles, you would want to use, the Nasdaq ones. So for the correlation, because some stocks are going to be correlated much or less, than others with the main index they are being traded within. So that's one option that can be used. So let's get on with it. In terms of how to properly adapt this strategy, if you truly want to do it, just as with the other one. So in this case, you want to go to the beginning years. I don't know if this case is going to allow me to go with, for example, 2010. So in this case, I don't know if the future option is going to allow you, but if it doesn't allow you, you can do two stuffs. So you can take, for example, in this case, the data. So you will take, for example, first 2010, I would say 2014. And once you have that data of 2010, 2014, of course, this graph is not going to be fully represented because it takes into account all the data that we have, but we can remove it. But from where is it? It's still here, So in this case, for example, you will use these values, and with these values you will have and take a look and see if in the future it's going to perform the same way. The most important that is going to be, the profit factor that we have, the win percentage, and stuff like that. So like for example, if you trade from 2015 to 2020, which is right now, you can see more or less the profit factor now. Wow, it's even bigger, but that's mainly because of 2021. So without taking into account the 2021 because of the corona, you can see more or less here that it's even better. So overall, it's a valid set of settings. But if you, let's say, for example, if you want to take a stock, so let's go and take a stock, for example, in this case, like I said, let's go take Apple. So I forgot to say, as a time frame, in general, I prefer 30 minutes, 1 hour, 2 hours, 4 hours, just like with dominoes. So the same, like I said previously, you can see you can use the correlation with the data if you want, from the other one, from the SPX or from the Nasdaq, if you want just long, or if you want long and short as well. You can see that even with short it's still profitable. And the settings, yeah, 0.1, 0.2, 0.5, you know, you're going to change with these ones. So you can see in this case, more or less without so many settings, you can see that the parameters that we already have, you know, from the Nasdaq, they are valid for Apple as well. Yeah, let's go back. Let's take another one. Let's take, I want to take the default. So let's take, for example, I would say Tesla. And you can see same stuff. It's a little bit lower than the buy and hold, you know, from the Tesla, but yeah, with a little bit of optimization, I believe you can get it even better. I don't know, strategy. Maybe by changing, you know, but yeah, changing the stuffs here, you can see that it's going to adapt one way or another. Let's go, for example, for the SPX, and on the SPX, if you want, let's go with QQQ. No, but TQQQ. And you can see in this case, you know, they can adapt as well for these ones. If you want to use the correlation, you can see that you can get even better data. So yeah. Now, in order to know how to properly, you know, how to properly set up an alert, we have the alert, long exit, short exit, and always I recommend once per bar close, you know, with the message and stuff like that we have here. Now, in terms of pro and con, well, I would say it's a trend trading strategy. It's mainly adapted for the stocks. The profit factor that it has is huge. It's generally is going to be buy and hold. Yeah, it can be automated as well if it wants. It can also use as a manual trade. Regarding the negative, it's going to be affected by sad market. It's going to, you have to be careful when you are going to optimize it to be sure that you are going to respect the rules. You know, like when you do the in general with the stocks, you know, when you have such a huge margin of years, it's less of a problem than it is with crypto because it's not so volatile. And then you can, for example, once you take, for example, a set of settings, and you can see that set of settings is going to work with many assets, not just the index and not just one time frame, then you can reduce the factor, you know, of having overfit situation. It's not like with crypto, I would say, because there is much higher correlation here. So it's going to be that. From one part, yeah, as a side, yeah, I can put it as a con because many people are impatient. You know, it requires a lot of patience. You can see that in this case we can stay like from one trade to another. We can stay like, look at this, 3 months, 4 months. You know, you can stay in a trade. So like, look, for example, this one, 170 days. So yeah, you are not going to have so many trades with it. So patience is going to be required with it. It's more like a swing trade strategy. Look, for example, this one, 200 days. You know. So on. So yeah, it's mainly used, once again I repeat, for swing trading. So yeah, there we have it. Let's put back the table. So yeah, that's what we have, you know, for this for the Ipsimus strategy. Yeah. And also, as a very positive factor, I like it that it has very low drawdown to profit factor, you know, to the net profit, sorry. You can see in this case 30 times, which is huge. It's huge, very nice. And we can see we beat the buy and hold. So yeah, this is what we have for the Ipsimus. So hope you enjoyed and see you next time. Bye bye.